Yeah, hi. So, good evening all. And I presume that each one of us who have joined are associated with markets or different kind of asset classes, be it directly or indirectly. So, what are we looking for in today's session? So, just to put a fun fact, amongst all the asset classes, foreign exchange is the most liquid and has got the highest turnover. As per BIS, that is Bank of International Settlement, the turnover in global foreign exchange market reached 7.5 trillion per day in the last calendar year, which is almost 30 times greater than daily global GDP. I'm saying daily global GDP, and almost 2.5 times of India's entire annual GDP. Roughly around 3.2 trillion is India's GDP. And yeah, with $1 trillion, one thing that struck my mind is yesterday Nvidia become the first semiconductor company to be part of this coveted $1 trillion club. And as we see over here, we are always excited to hear from analysts or traders who are bullish on markets. So yes, why not? Nifty and yesterday even Bank Nifty reached its all-time high. So when we are standing at such kind of inflection point, to borrow something from technical analysis that we do on daily basis, day in, day out, we look back on the charts and study various technical patterns, their formations, and how markets have reacted to the same. So here, when we are going ahead with this particular presentation, we'll be taking one particular country at a given point of time, look at its fundamental, and then look at the currency it's having, its technical part, and projecting it how it's going to move in future. So I guess everybody is ready for that. We shall move ahead. Yeah, so this is something quite amazing, quite witty image, I would say. So to begin with, we'll begin with the United States. So in this particular image, what it has done is we have correlated the heights of Fed chair along with the Fed fund rates since 1979. That is almost 4.5 decades back. So first, on the left-hand side, Mr. Paul Volcker, he was really a tall guy. So during his particular era, the inflation peaked at around 14.80% in March 1980. 14.80% the inflation. And the Fed fund rates were peaking at around 20% during that particular time frame. And due to this particular monetary policy, the inflation fell to 3% in less than 2.5 year space in 1983. The Fed board led by Volcker raised the Fed fund rates to a peak of 20% in June 1981. Of course, it was followed by a recession as well. Then we move on to Mr. Alan Greenspan, who was one of the longest serving Fed chair. During his time, the Fed fund rates were above 6%, followed by Nobel laureate Ben Bernanke, in whose tenure Fed fund rates were just shy of 6%. So we can just correlate with their heights over here. Interestingly, during the tenure of Ms. Janet Yellen, the interest rates were near zero for almost a couple of years. And now in Mr. J. Powell's case, the Fed fund rates are already at 5 to 5.25 corridor. And with exactly a couple of weeks to go for the next FOMC, which is on 14th of June, there's 25. There's chance, almost 2/3 chance of 25 basis rate hike. Of course, before that, there are some crucial data, that is US NFPR and unemployment by this weekend. Then US CPI data, which are lined up, which would hold key for this particular rate hike. Moving on, in this slide, we'll be seeing the fastest rate hike in last 4 decades in US. So the current cycle, that is still in process, we have seen that already 5% rate hike has already done by Fed in last 14 months. And the slowest one on the right hand side in purple color that we can see, where in Yellen's tenor, the rate were around 2%. The rate hike was done around 2% in a span of almost 3 years period. So this is one of the fastest in almost last 4 decades. Now this is quite interesting. We'll just look at the chart of dollar index over here. So this particular chart of dollar index is from Q1 of 2020 to almost 3 years. It is covering in this. So in this, during the COVID time, are you able to see my mouse over here, right? So during the time of COVID, it peaked at 103 levels. And then from there on, with positive news coming in regarding vaccination and all, it fell down to almost 90 levels, sub 90 levels. And then when the global, this was only because of the global optimism which was there during that particular period. Then on the left hand side, if we see, this was entirely during the COVID-19 cycle. It was entirely due to risk aversion period, because of which dollar index had made 3 years high at that point of time. After 2021, we have seen the perils of ultra loose monetary policy, which kicked in with abundance of liquidity and have given rise to higher inflation. To make matter worse, on Thursday, 24th February 2022, Russian invasion of Ukraine happened, and because of which crude oil and natural gas prices shot up unprecedentedly. But Brent crude futures hit almost $150 per barrel during that period. Because of that, energy, along with energy prices, even the commodity prices shoot up, and inflation overshooted in the entire globe. The 2% target level for Fed was breached comprehensively and soared to almost 9.1% for the month of June 2022, before it started to cool to current levels of 4.9% for the previous month. But then still, US was doing far better as compared to G7 peers, who were struggling with sky-high inflation. And recently, we have already seen Europe's biggest economy, Germany, also slipped in recession. So what we can see in this particular chart is, when such kind of events happen, dollar tends to appreciate when the global economies performance goes down. And just keep this particular image in mind for some time, as this particular chart is linked to the next slide. On left hand side, we have seen dollar appreciation because of risk aversion. In the mid, we have seen global optimism, because of which dollar index almost depreciated by 13 to 14%. And then in October 2020, 2022, it made 2-decadal high of around 114 levels. So what we can see here is the theory known as dollar smile theory. In this theory, what it suggests is, in the between, we can see US economic data, and if the US economy is performing or underperforming with respect to its peers, dollar tends to appreciate because of its safe haven demand. And on the right hand side, we have seen that when US economy increasingly outperform the other global economies, we have seen dollar index appreciating with respect to other currencies. So that's why in the previous slide of dollar index, what we have seen, this was risk aversion, then dollar depreciated, and it made almost a 2-decadal high when the global economies were suffering. So this is just a good example of the dollar smile theory. By the way, this particular theory was formed by Stephen Yen, who was a former economist at IMF and Morgan Stanley. So moving on to Eurozone. So we will catch a transatlantic flight and come to Eurozone, who is really struggling now. So what we see here is inflation vis-a-vis interest rate of Eurozone. On x-axis, it's 3 years period starting today, going back to 3 years, this particular thing. Then on left hand y-axis, it's Eurozone's inflation rate. And on the right hand side, it's ECB's interest rate during that particular period. What we can observe here is till 2021, the Eurozone was struggling with deflation as inflation was sub-zero levels. However, the perils of ECB's PEPP, that is Pandemic Emergency Purchase Program, came in, which was ECB's monetary policy measure initiated in March 2020, which involved a significant expansion of their balance sheet. Because of that, the inflation soared to all-time high of around 10.6% in October 2020, before falling back to current level of 7.6% YY. On the right-hand y-axis, it's ECB's policy rates, which currently stands at around 3.75% with 25 basis hike in the previous monetary policy. But the policy rates are at highest level since 2008. However, with the inflation still way too higher than 2% target levels of ECB, we can expect a further rate hike in upcoming policy, which may dent Eurozone's sentiments, as already their economic powerhouse, Germany, is in the recession. Moving on, this is quite an interesting chart. This is of EURUSD. Now, this particular chart consists of entire life cycle of euro. So, euro came into existence on 1st of January 1999, and as the dot-com bubble struck in, it made an all-time low of around 0.81 levels that we can see over here in 2001. And from there on, there was no looking back for euro, and it doubled its value almost in 7 years to 1.61 levels, just before the GFC came in 2008. Since then, on a longer time frame, as we see, euro is in a continuous downtrend. Another more interesting thing over here is, if we take the retracement of Fibonacci retracement of this, we can see a steep resistance. Earlier, there was a support for euro at around 1.21 levels, and that particular level has acted now as a resistance in the previous decade. As we have seen in October 2020, inflation soared to all-time high of around 10.6%. Euro hit its two-decade low and came below parity for the first time after 2003, almost a two-decade low for euro, and it hit a level of 0.9534 in October 2022. Before bouncing back to this 61.8% Fibonacci level, where it's finding a steep resistance over here. Another thing to notice over here is it's getting resisted over this particular trend line, which is acting, which was earlier acting as a support for almost 3 to 4 years. Once this trend line was break in the last calendar year, it made this low, and now that particular level is getting resisted over there. So the levels for euro, what we see for the next few months, will be around 1.0450 to 1.11 levels. Now we will take a 50-kilometer long underwater channel tunnel to reach UK from France. And after reaching UK, what we found out is Eurozone was struggling, but UK is struggling miserably. Here again, same thing. On x-axis, it's 3 years period starting today and going back to 3 years. On left hand y-axis, it's UK's inflation, and on right hand y-axis, it's Bank of England's policy rates. The story almost remains same, because for almost an last decade, UK was also was struggling with deflation, and it was trying to pull out push up the inflation rate up to 2%. So 2% is Bank of England's targeted zone. And once the pandemic followed by Russian invasion of Ukraine happened, the matter made worse for UK. UK's inflation made all-time high of around 11.1% in October 2022, and for the first time in the previous month, that is in April, in the last particular month, the inflation fell below 10% barrier. It reported a figure of around 8.7% after 7 months, which is again best inflation print in the last entire 1 year. Bank of England, in its policy in the same month, in the May itself, they hiked rates by 25 basis points, making 12th consecutive rate hike in line with market expectations. Thus, the borrowing costs in UK are now at fresh highs since 2008. Now we'll just take a look at GBP. So this particular chart is of almost 7 years. It's again a GBPUSD weekly chart. And what we can see over here is a white horizontal line straight over here. So if most of us may recall, on 23rd of June 2016, there was a referendum which was conducted for Brexit, and 52% Britishers opted to leave European Union, setting the stage for UK to become the first country to leave European Union. On 1st of February 2020, UK formally withdrew itself from European Union, and thus the white horizontal line indicates fall in GBP. So this particular fall was around 24% in a matter of hardly 15 weeks, and it failed almost big figure 36 points against USD during that particular tenor. It came down from 1.50 levels to 1.14. From there on, it tried to recoup all the losses and made a high of around 1.4350 levels during 2018, when dollar index was struggling. During COVID-19, GBP again struggled as almost all the major currencies, apart from the safe havens like dollar, yen, and CHF, and made a low of around 1.14 levels, only to recover to take resistance at 1.43 levels once again. And if we can see over here, there's 2 times double top formation happened, and GBP failed to break that particular formation, took heavy resistance over there, and fell steeply to almost 1.03, its all-time low against dollar in October 2022. So currently, GBP is trading in the range of 1.2380 kind of levels, and this particular level falls between golden level of Fibonacci, which is between 61.8% and 50% retracement of this entire move. On GBP, our view is the levels of 1.2345, where it's currently, are very crucial because it's 50% Fibonacci level, and already it has break this particular trend channel, which was almost which lasted for almost 1.5 years, and break of that trend channel plus support of this. If this particular support gets breached, we can expect GBP to fail down up to 1.18 levels, which will be 38.2 Fibonacci support levels. Moving on to Japan. In Japan, this chart again shows inflation against interest rate. The left hand axis shows Japanese inflation rate, while the right hand shows Japan's interest rate. Same story in Japan as well. Inflation peaked in Japan in January 2023, this year itself, at around 4.3%, with last month's reading coming at around 3.5%. These are almost 3-decadal high inflation numbers, which Japan has shown with ultra loose monetary policy of Bank of Japan, earlier under Mr. Kuroda and now under Ueda. In December 2022, the Bank of Japan caught markets off guard by tweaking its yield curve control, YCC, to allow the yields on 10-year Japanese government bond to move 50 basis points either side of its 0% targeted levels. Currently, Japanese policy is at around minus 0.1%, the only economy in the entire globe to have negative interest rate still now. Now again, this is USD JPY weekly chart. This particular chart is of last 3 years. Over here, what we have done is it's a retracement of safe haven demand. So as we already know, safe haven currencies like USD, Japanese yen, and CHF tends to appreciate whenever there are situations like war or COVID-19 kind of pandemic creeping in. So during that particular time, JPY made an high against USD of around 101 levels. But after that, due to policy diversion, it went up to 152 levels. So it fell almost 50% in past 3 years and made a 33-year low for JPY. This is only because of policy diversions between US and Japan. Currently, it's trading around 139.63 kind of levels. And over here, what we can see a dark Marubozu red candle. That particular time, Bank of Japan intervened very heavily in FX market. They sold roughly 75 to 80 billion odd dollars during that particular period to curtail Japanese yen depreciation against USD. Now we move on to gold. So this particular chart is quite interesting. So this is gold from central bank's perspective. So this particular chart consists of last 3 decades. So it's from 1992 to 2022. As we can see, till GFC of 2008, central banks were selling gold because of prolonged dip in gold prices. After GFC, due to higher inflation in emerging market economies and geopolitical uncertainties, central banks bought record gold during this particular tenor. And last particular year, all the central banks together bought 1136 tons of gold in 2022, which is highest in last 56 years. Emerging market economies like Russia, China, India, and Turkey are the largest purchaser of gold in this particular time frame. One fun fact here is all the global central banks put together hold roughly 1/5 of the total gold that has been mined till date. As we look on to this particular chart, this is USD, means gold against USD, XEU against USD chart. This is again a weekly chart and it's of last 3 years. So what we can see over here is a quite interesting thing. So whenever safe haven demands creep in, gold makes an all-time high. So in March 2020, due to COVID-19 pandemic, gold made an all-time high of around 20,070 levels. Again, when Russia's invasion of Ukraine happened in 2022, gold made almost same levels of high during that time. And few weeks back, due to debt ceiling issue, gold again made almost high at that same levels. So it's already a triple top at that particular level, and it's facing a steep resistance at those levels. In the meantime, during 2022, gold even came down to 1640 odd levels, and from there on, it appreciated almost 25% till date. So now comes the champ over here. What we can see in this particular chart, we haven't observed in the in its peers, like big peers like US, Euro, and UK as well. Here on both the axis, both the sides, the inflation rate and interest rates are mostly contained in a very narrow range. So again, this inflation is for last 3 years, or where we can see that India's inflation peaked at 7.79% in May 2022, which was almost 8 years high. When the Eurozone economy's inflation was more than 10%, and UK managed to get inflation back below 10% only for the first time in last 12 months. India's inflation peaked almost a year back at around 7.79%, way too less than developed economies. And this actually justifies RBI's stance of status quo in the previous MPC. What one more thing we can see over is RBI, after delivering 6 straight hikes, unexpectedly kept repo rate unchanged in the previous MPC of April 2023. They have lifted rates by aggregate 250 basis starting from May 2022, pushing the borrowing cost to highest level since Jan 2019. Now this is our champ, USD INR against FX reserves. So this one is quite interesting. Over here, this is 1 year chart, and what we can see as the financial year of 22-23 begin, dollar rupee was trading around 75.25 levels, and we were having FX reserves of around 606 billion during that particular period. Due to Russia's invasion of Ukraine and inflation crept in almost every single economy of globe, all the emerging market currencies along with G7s started to depreciate against USD, and dollar rupee made its all-time low of around 83.29 levels on 20th of October 2022. During that particular time frame, RBI was constantly selling dollars to curtail the volatility in FX market and to hold the run on rupee. FX reserves fell sharply by around 81 billion and made a low of around 525 billion on 21st of October 2022. But from there on, we have seen that as dollar index, which was at around 114 plus levels during that particular month of May 2022, dollar index has came down, but rupee is currently trading around the same levels. This is because whenever rupee tends to appreciate, RBI is constantly there bidding dollars in market and supporting dollar. So what we can see over here is this is a good triangle formation that has happened in dollar rupee for almost last 8 months. And every single time, whenever rupee is touching this support, RBI is there to buy dollars and make good of whatever dollars they sold in the previous calendar year. Just before a week prior, our forex reserves almost went up to 600 billion, and current trading came at around 593 billion for the last week. And what we can expect on dollar rupee over here is, and looking at last week's dollar sale by RBI, RBI is trying to protect the levels of around 83 to 83.30, and there is a huge resistance at those levels. If a break of this particular triangle happens, it will happen at the vertex of this particular triangle, so which would be almost some 2 to 3 months from today. And if that breakout happens, it would be roughly this particular move. So this entire move of around 2.5 rupee will be captured over here from this particular level. So even if this particular level breaks in future, what we can expect is dollar rupee may go up to 84.50 to 84.90, whereas next Fibonacci levels are coming. And looking at our domestic cues and FII data, so FIIs are continuously pumping dollars in Indian markets. The chances of this getting break is quite slim, and even RBI is there to protect this particular levels. So we expect the dollar rupee range for this year end to be roughly around 81.50 to 84.20 levels. So enough of fundamentals and technicals. So this is what we do. So this is our trade setup for every single day. So what we do is we pick up all the G7 currencies, equities, bonds, bullions, and commodities, put them in some such a small snippet, and just put the current levels, previous days high and lows. Then looking at technicals, we put out resistance 1 and resistance 2, and similarly support 1 and support 2. If any economic data that is going to come for that particular day, we will put that as well. And we will look at trend in weekly patterns, in daily patterns and hourly patterns. And then we will initiate our position for that particular day. So this helps us in our trade, and more often than not, we are successful in getting our trades right. So positioning for trade. In markets, patience and discipline holds key along with money management. So the board approved limits for any asset class along with regulatory guidelines are supremely important. So risk management is very critical. So as these guys are discussing, after taking a trade, the long and short, so they long and the market shorted on them. So even after doing all fundamental, technical or quant analysis, there are probability that your trade may go wrong because of certain technical issues in market. So let market commit to you before you commit to markets. Thank you.
So Abhishek, thank you so much for giving us the outlook. Of course, literally you took us for the world tour for the different economies and good dynamics of inflation, interest rate, and how the currencies are impacted. Now is the Q&A time. I request all the participants to either raise hand, use the raise hand option, or if they can post the question in the chat box, I'll read it out for Abhishek to answer it. Abhishek, if you just want to look at the chat, I think there is some communication which some of the people have posted for you if you want to address that. In the meantime, question gets populated. So Abhishek, since the audience here is from the alternate fund space, and of course, day in and day out, they deal with the investor class, which who are looking at Indian markets from a short-term and long-term perspective. So of course, for this year and like dollar rupee range, you have indicated as 81.50 and 80 to 84.20 is our in-house view. But from a long-term perspective, any cues if you can give to the community so that when they're discussing with the investors or the different stakeholders in the entire ecosystem, they can take away from the session.
Yeah, sure, noted.
Okay, I'll take one-on-one question. Harsh Prajapati is asking, what is your opinion about crude oil, long range or short?
So crude oil currently, we are actually thinking to put crude oil also in this particular analysis. So according to us, crude oil, which is currently trading around a zone of 75 to 77 levels, it depends on US debt ceiling plus the OPEC plus meeting, which is going to happen on 1st and 2nd, and even Ukraine's war outcome as well. So moreover, our range on crude will be from 72 to 84, 85 kind of levels on a broader level in given span of almost 3 to 4 months.
Sure. Deepak Chodia is asking that how a global slowdown or recession impacts the forex markets.
Yeah, definitely. It impacts forex market. Just a moment. I'll just pull up my slide. As I've already mentioned in my earlier slides as well, recession or such kind of a thing will impact your economy uh, in a way in which particular economy you are sitting. If you are sitting in US, or if you are sitting in Switzerland or in Japan, definitely on currency its impact will be positive, because they are deemed to be treated as safe haven assets. So whenever such kind of scenario happens, those particular currency tends to appreciate. Here we see dollar index getting appreciated to almost 3 years high at the peak of COVID. Similarly, during October 2022, dollar index hit 2 decadal high when Russia's invasion of Ukraine happened. Inflation was persistently about 10% in Eurozone and in UK, 9.1% in US as well. At that point of time, dollar index was doing good. So this is particularly explained by this dollar smile theory. So if you are sitting in US, it's good for you. When global economy suffers, it's good for dollar. If your economy means US economy is doing good as compared to others, again dollar index will appreciate. But if you are sitting in country like India or any other G7 countries apart from Japan, the scenarios are entirely different. What we can see over here is during the pandemic, euro made of a low of around 1.06 levels, and in October 2022, when the inflation and run on commodities and crude oil prices was going on, euro made 2 decadal low of around the 0.9534 level. So it fell below parity for the first time in last 2 decades. So those are critical impacts of recession on a given economy and that particular currency. So same thing has happened in India as well. So rupee So during the same time, rupee made its all-time low of around 83.29 levels. And if you can see, that particular chart is not over here, but if you can see in the past, during April 2020, rupee made then all-time low of around 76.92 levels on 23rd of April 2020. So yes, when such kind of events happen, it's bad for emerging market economies and for G7 apart from US and Japan.
Thank you so much, Abhishek. There are more couple of interesting questions. One is on the forward rate. So Bhavesh Kataria is asking that recently forex forward rates has come down to around 270 basis points in comparison to 4 or 5% which we normally used to see. So what is the reason for this, and what is the outlook on the forwards?
Yeah, so the reason is quite simple. So the forward premiums are derived from interest rate parity between the two countries. So given USD INR, in case of USD INR, the interest rate in US, the overnight Fed fund rates and the repo rates in India, this defines where our swap rates would be there, because many carry trades are linked to this particular overnight swap rates. So what earlier used to happen before 2020, US Fed fund rates were near zero, and India's repo rates were around 6.5%. So because of that, we used to get roughly around 4.5% of annualized yield on our forward premiums. But as US started to hike their interest rates, and currently RBI has made a status quo in the previous monetary policy, and going ahead as well, we can expect a status quo. And in this particular monetary policy on 14th of June, if FOMC hikes the interest rate differential between these two currencies will further come down, and that's what we are seeing or getting factored in our premium markets. So the entire curve starting from overnight to 1 year has shifted down very drastically, and even it hit almost 12 years low roughly in the month of December 2022, when the annualized yield fell to 1.61%. Hope this answers.
Yeah. Next question is from Kishore Juvekar. What is the outlook on Euro INR till March 2024?
Yeah, so Euro INR is a derived of Euro USD. It's a derivation of Euro USD and USD INR, and it's directly proportional. So in this case, if Euro USD, as we can see, first we'll speak about USD INR itself. USD INR, if this particular level is taken out, we can expect USD INR to go up to 84.50 to 84.70 kind of levels. But at that point of time, with dollar appreciation, we may see a depreciation on Euro against USD. But the depreciation of Euro against USD in proportion will be lesser as compared to dollar INR. So the range on Euro INR will be roughly around 88 to 90 kind of levels.
Sure, Abhishek. Hope it helps Kishore for your conversation with the Euro-based investors. Next question is Shivam Agrawal is asking how inflation data affects forex markets.
Sorry, how inflation data affects forex markets?
Yes.
Yeah. So it's a good question. So inflation holds the key for all this turmoil which has happened in previous 2 years. So with US pumping in a lot of money in their economy after pandemic, and Eurozone coming out with PEPP, inflation over there moved to almost a decadal high. And with such to curtail this kind of inflation, your currency needs to adjust to those pressures. And because of that, your currency tends to depreciate with the stronger inflation currency. Else, there will be carry trade that would be derived from these markets, and traders will be trying to book profit out of it. So the prime example of this is JPY. So what has happened since 2021, Japanese monetary policy till date, they have maintained their policy stance at minus 0.1%. However, in US, we have seen almost 5%, 5%, that is 500 basis rate hike as compared to yen. So in this particular period, as Japan was unable to hike interest rates, yen failed against USD because there were carry trades that were originating out of Japan, and the funds were moving to higher yielding currency from low yielding currency. So you borrow from Japan at a cheaper price, at say around 0.5%, and invest it in US treasuries at around 5.25%, and then book a 1 year forward and get them back after 1 year hence. So you are going to get benefit out of it. And with this depreciation, Japanese bank, the central bank, the Bank of Japan, had to intervene very heavily, and they sold roughly around 75 to 80 billion odd dollars to curtail the run on yen in this particular months. So this was all because of inflation and divergence in monetary policy.
Great. So thank you so much, Abhishek. I think there are no more questions. But my earlier question: any long-term our in-house view on dollar rupee for 2 to 3 years?
Yeah, definitely. So let me just come to dollar rupee chart. So as we have seen, this particular triangle, if this particular triangle breaks at its vertex, we will see this entire move happening over here. which goes to almost 84.5 levels. Plus, if there are negative sentiments that are getting created in the market, and rupee historically being a depreciating currency because of its higher inflation and higher interest rate as compared to US, it has to depreciate in coming years as well. So what we have seen, if we do an analysis from 50 rupee per dollar to 60 rupee, it almost took some 6 years for rupee to move from 50 to 60, and from 60 to 70 it took around 4 years, and from 70 to 80 rupee it took around 3.5 to 4 years. So similarly, from the current levels of around 82.75 to around 90 level, our view is within a span of 2.5 years, rupees should be around 88 to 90 kind of levels, being uh, higher inflation and higher interest rate and carry trades coming in.
Sure, Vishek, thanks. From Deepak Chodia, there is one more question that can you throw some light on the sectors which are positively or negatively impacted due to FX movement?
Definitely. So all the importers and exporters are looking at FX markets because their entire quarter's revenue depends on this. So IT sector, if you look for, whenever rupee tends to depreciate, IT sector is in green, and whenever rupee tends to appreciate, it makes oil marketing companies like Reliance, IOC and all in green. So because they need to make the importers need to make payment in dollar terms, and a cheaper dollar is always good for their revenue. And the same thing goes in a vice versa term for exporters. So our IT exports or pharmaceutical exports, this group of people, this bunch of people benefit out of rupee depreciation. So whenever FX whenever we see a dollar appreciation, all our software giants are in green.
So we have 5 more minutes. Okay, Deepak has one more question. How advanced has the hedge market in India has become?
So for hedging, there are a few perspectives to be given. Firstly, plain vanilla forwards. A lot of clients are booking plain vanilla forwards, but if we go beyond forwards, there is a lot of room for options and option space. So we definitely will try to encourage our audience over here to go and look for options as well, because options are a very good thing, because it's low premium and they can give you an excellent kind of results. On forward space, the plain vanilla forwards, it's quite a developed market. We are having good volumes also in forwards and swaps market. On daily basis, the volumes in almost 1 year or 6 months bucket are more than 3 to 4 yards. Yards means around a billion. So the forward markets are quite matured, and even with Gift City coming in and NDF hedging facilities available for our exporters and importers, those are again another avenues what the exporters and importers community can look for.
Just complementing what Abhishek has told right now. So, of course, from a regulation perspective, if you see the new hedging guidelines which has come in force from 2021, where the RBI also moved to more principle-based approach. So, if you see from an Indian hedging market perspective, it's more like in line with the global, where RBI or the regulation has made it very, very easy for the genuine the risk management from a forex perspective. So hence you have contacted anticipated exposure kind of the guidelines have kicked in and all that. And of course, as Abhishek told that NDF market also in the last announcement, which has been open to other resident customers also. So now there are many opportunity for a resident the customer or the entity who is having any kind of FX exposure to look for onshore offshore markets to hedge their exposures. So from a regulation perspective, it's now quite liberal and open and all that. We have one more question from Harsh Prajapati. What is your opinion about Nifty 50 chart?
Nifty 50 almost it's nearing to its all-time high of around 18,888 levels, which we have seen a few months back, and those particular levels are quite significant. There's selling pressure. There's a double top formation at that particular level. For this breakout to happen, we need to see a lot of influx from FIS community, and which we are seeing for this entire month. So the May month, after a long time, is quite positive on the FIS inflows. Along with that, we are having a very good domestic inflows as well. Bank Nifty hitting all-time high is a very good sign, and our view is positive on India, and definitely you should go long on Nifty.
There's one more question from Bhavesh. Is there any difference between a forward rate of NDF in GIFT City and forwards in domestic market? So he's asking more of onshore offshore forwards difference, or are they in the same correlation?
It's almost same correlation. Hardly whatever discrepancy is there, it's because of arbitrage only. But almost the markets are very matured in both the section, the OTC and even in the GIFT City as well. So it's a welcome move. We can definitely, the clients can definitely look to explore booking forwards through NDFs. Only because of arbitrage, there's a lot of spreads.
Right. So we have reached our scheduled time. So thank you so much for all the participants. Thank you, Abhishek, for the elaborate discussions and how a forex trader life on a day-to-day basis looks. Thank you so much for giving a purview of that. Abhishek's and my contact details are there with the eQualify team. If anyone has any question afterwards, or if anyone sees the session on the recorded line, and if he has any questions afterwards, happy to address those. So you can get our contact details from eQualify team, and we'll be very happy to address. From a bank perspective, of course, we are keenly want to engage with AIFs, and of course, we'll be very happy to work with them and to offer our risk management solutions from an offshore or onshore investor perspective. Yeah. So thank you so much for the opportunity. eQualify team, thank you so much, and we can wind up the meeting. Thank you so much for all the participants.
Thanks a lot.
Thank you.